Hey traders, welcome to a global macro update. We'll be going over a few fundamentals, more on the global macro longer term picture and going over the potential of deflation, inflation. This is a discussion that we do talk about quite a bit, but it is pretty important as to where we're going in the next handful of years, in my personal opinion. So first thing we want to talk about is the Lebanon currency and free fall amid political basically destruction. We can see the Lebanese pound was reportedly selling for 6,200 to the dollar, losing more than 75% of its value. Pretty crazy. And this is somewhat recently. I didn't really cover more on it, but basically we can see there's another post, another article. Distrust in the Lebanese bank spurs Bitcoin boom. So we do talk about other countries that have banking crises and issues, looking at Zimbabwe, Venezuela, that happened recently, and then now we see that the Lebanese banking system is starting to crack as well. And what we like to understand is what happens during these situations, because at the end of the day, people are people, right? Certain countries may act in different ways, but at the end of the day, people are losing value and they need to put it somewhere in which it's not going to lose value as fast, where they're going to somewhat trust the supply that is said to kind of increase as people find it, people mine it. If you're looking at gold, looking at silver, you can't just create gold and silver out of thin air. You have to be able to mine it, which costs energy. And people say, asteroid mining and stuff. I think that we're still enough ways away from that, but that gold would be a better source for the long-term investment compared to currencies. And then obviously with the digital realm, I think BTC and cryptocurrencies, blockchain, do provide a better source of value in terms of being able to actually exactly know at a mathematical formula in an algorithm how much the inflation rate or deflation rate is going to be. So in that sense, I think that is a better way to go about doing things, but obviously you do need the internet for that, and if there's like a global EMP or some crazy destruction of electricity, of energy gets taken place, that would be pretty bad for any sort of blockchain or any sort of electrical ledger that stores value in certain accounts using electricity. So we can see, let's read this a little bit, talking about the Lebanese banking system. So when Mahir, I think his name is, an engineer in his mid-30s, returned to Lebanese flush with cash from working in the Gulf, he deposited hard-earned savings in a bank, believing they would be safe. But as Lebanon has spiraled into its worst economic crisis in decades, banks have imposed informal capital controls that force people to withdraw their savings in Lebanese pounds at the official exchange rate that effectively values their savings at 40% less than what it was worth on the parallel market. Nothing can prepare you for this shock of this, or nothing can prepare you for the shock of this. Said Mahir, but people are turning it to something else. But Mahir, who asked his surname be withheld to protect his privacy, is not standing by helplessly. He is trying to move what is left of his savings out of Lebanese via a financial instrument many in the country have not embraced until recently. Bitcoin, cryptocurrency, blockchain, right? So we can see, we're not going to get all the way into this article, but people are slowly switching into trying to use cryptocurrencies when they are faced with a monetary system that is rigged or basically stealing their value right in front of their eyes due to inflation, due to them printing money and devaluing the currency in circulation. That is the game of any central bank in order to try to create power out of thin air, create value of thin air, which is impossible. Got to have some sort of energy put into it. And we can see this is the Venezuela's BTC transactions. This is the weekly local Bitcoin volume for BTC in Venezuela. And we know that Recently, they've had a hyperinflation where the value of the currency has diminished extremely quickly, and we can see that they are in the midst of the highest point of weekly BTC transaction volume that's ever occurred. So we can see people are moving into cryptocurrencies, BTC, in order to try to hold their wealth. Argentina is also another country that is suffering from a devaluing currency, and people are getting worried, people are getting screwed, and they're basically losing their life savings. So they've already had debt issues back in 2001. The country was left with lingering distrust of banks, and I think this will happen with any country really that suffers from inflation, especially central banks, because they're the ones who actually print the money. But commercial banks who give you what they quote say give you and let you borrow money for a mortgage isn't really, taking it out of someone else's bank account. They're just creating that money out of thin air due to fractional reserve banking, and they're really devaluing your currency. It's pretty sad, but we can see that. Let's just read it here. As the months have seen another economic crisis characterized by the pesos falling to a record low against the US dollar. To protect their savings against such volatility, it's common for Argentinians to convert their pesos into the dollar and guard them at home. So the issue with everyone switching to the dollar, as we get deeper into the article, is people are going and using things like Tether or MakerDAO's DAI, which is a type of cryptocurrency which is pegged to the dollar. It is a stable coin, so theoretically, yes, it is going to store your wealth a lot better than a failing currency in, for example, a third world country. But if you're looking at this from a global scale over, let's say, a 5-year span, there's a possibility that the US dollar will basically hyperinflate as well. Look at how much currency that they've printed. Yes, there is the argument of, look at Japan. They have an extremely skewed demographic that is weighted to the elderly seniors, which basically is deflationary pressure. And then you also look at the velocity of currency, which is extremely deflationary as well. So then Japan has been in a deflationary spiral for the past 30 years since the asset bubble burst of 1989. So people look at that and say, hey, they can do it for 30 years. Why can't every other country? So that is the argument for deflation instead of inflation and hyperinflation, which is a valid argument, but the end game is going to be inflation, and it's going to be hyperinflation to some degree unless they're going to increase interest rates exponentially like they did in the 70s when it got to double digits. All right, so that's going to be basically the discussion for this, is talking about how a lot of these stable coins, it's not like they are actually stable. The DXY, which is the US dollar index, has fell multiple percentages. And so it's not like it's completely stable. Yes, if you're comparing it to things like the S&P, or you're comparing it to things like BTC or Ethereum, it's extremely stable, but it's still, if the relative strength of the US dollar falls, it's not going to be stable. It's not going to be a stable coin. It's going to be an unstable coin that's pegged to a shit currency that's going to devalue over time. Not the ideal situation to be in. And we have to see, it's not just these currencies that people normally don't talk about. Places like the UK, their pound is also seeing lots of volatility, and the Bank of America says it is acting like an emerging market currency like the peso, and that would be in the same basket as the South African rand, the Russian ruble, and currencies that have high interest rates, high volatility, and that's not good if you are using their currency to transact on the global market. You want a more stable currency. So it's not just the currencies that you don't hear about every day. We do see the pound, GBP, have crazy swings, and we've seen that recently when they announced that they're going to be performing stimulus and injecting liquidity into the market. The pound absolutely plummeted, which is odd because when the euro said that they are going to try to stimulate the economy, the euro increased and it strengthened. So you can't always look at the numbers, you got to look at the price action. And this is an extremely interesting table. This is most, if not all, the hyperinflations in the 1900s, and then there's one in the 1796 in France. But almost all of them, as you can see, is in the 1900s, and it is a table from the highest monthly inflation rate to the lowest. And we can see it's a cutoff of 50%. And you see countries that have very stable political monetary systems in place. Look at Germany back in 1920. This is when, during the Weimar Republic, they had like a pre-inflation and then a massive hyperinflation after. So you can see Germany, January 1920, they were, what was this one again? Highest monthly inflation rate, right. So this was inflating at 56%. It took 46.8 days for prices of everyday goods and services to double. So if you go to get an apple at your local grocery store, it'll double by a month and a little bit, which is pretty crazy. And that was 1920, and look what happened after in all the way up here, 1923. Look at the highest monthly inflation rate. It is 29,500%. It took 3.7 days for prices of everyday goods and services to double. That's unbelievable. And then you see places like Hungary's, we'll touch on that. We actually have another little post actually looking at how it happened. It's like every other hyperinflation, but 4.19 to the power of 16. That's pretty unbelievable. It took 15 hours for prices to double. Not even a day. That's crazy, right? If that doesn't blow your mind, I don't really know what does. But we can see, we see places that are very, what we think, stable. You can take a look at the list, and not all of them are going to be stable. You see Zimbabwe's 2017. You also see Venezuela's 2016 in there as well. We see Poland 1923, France, Peru. And America's 1970s CPI numbers were in the double digits. So it wasn't as bad as inflation, 50% increasing a month, but it was still pretty aggressive. And this is just a quick discussion of the worst case of hyperinflation in history. And this is Hungary. Prices were already rising in Hungary after the world because of production capacity fell due to the destruction. With no tax base to rely upon, the Hungarian government decided to stimulate the economy by printing money. Sounds very familiar. It loaned money to banks at low rates, who then loaned the money to companies. The government hired workers directly, they provided loans to consumers, and they gave money to people. Sounds familiar yet again. The government literally flooded the country with money to get the economy going again. Money may not have grown on trees, but it certainly flowed off the printing presses. So it is basically just printing money that creates situations where you get doubling of prices in 15 hours. This is obviously an extreme case, but it happens. And we do have to understand that the United States dollar is not immune to situations like this if they continue the amount of printing that is going to be required in order to stimulate the economy to basically not have a recession, which is, in the Fed's eyes, a desirable goal. So that is going to be it. We're going to go over a few more topics here in terms of paragraphs. At the height of the inflation, prices were rising at the rate of 150,000% per day. Pretty unbelievable. Government had stopped collecting taxes altogether because even a single day's delay in collecting taxes wiped out the value of the money the government collected. That is unbelievable. So how did the people cope with the onslaught of money? So they basically just recreated money and put a different color on it and hoped that the people living in the economy would have confidence behind that currency. We can see that the government's solution was simple: change the name of the currency. The pango was replaced by the mil pango, which was a million pangos, which was turned and replaced by the bill pango, and then it goes on and on and on. And then at some point they had an inflation indexed currency. That is pretty crazy. So these situations have happened before. Just looking back in previous historic monetary collapses, you can see that it does happen. It's not just a first time for everything. Usually you can look back in time and see that it's happened before, and when you're studying them, it gives a pretty good idea of what could potentially play out in the future. Obviously you don't know for a fact, but looking at history, people won't react exactly the same, but humans are humans. They get fearful, they get greedy, right? So understanding what happened in history does play a pretty crucial role in the potential outcomes that you could capitalize on if you are navigating the financial markets. So let's now first look at the S&P 500. It did move pretty sharply to the downside. We did call for a fall to the support zone of around 30.75 when we were in this squeeze of this consolidation zone with this ascending zone squeezing the price into the apex, and then from here to the move down was a pretty aggressive risk off situation, which was great to see. And then now we're holding the previous resistance as a new, or previous support as a new level of resistance. It was also a previous level of resistance as well, but then that turned into a new nice structural zone we can see right here before we now then broke it again. So it does look like we are in a risk off situation. The fact that we're making lower lows is not great. We failed to make a higher high, not twice, 3 times, but 4 times. We squeezed up, and then once we got the failure of the 4th high, buyers could not hold the confidence, and sellers took charge and had the conviction to push the price even further down. So what I am going to do is just connect the lower highs and see what we're able to identify in terms of a potential descending wedge of some sort, maybe, because we don't want to assume that it's going to continue to fall forever. There is probably going to be some sort of bounce. Obviously, that market moving in waves, you got to assume that there's some sort of support that's going to hold. So we do have a descending trend line that is holding the lower lows, and now we're in a tight consolidation between the support, which is holding our lower lows, and then the new level of resistance at around 30.72, 30.75, which was our previous level of support since around mid-June. So that's going to be the S&P. It does look pretty good. I don't want to call it too early. It could bounce a little bit higher. So let's get our snip and discuss it a little bit in more detail. So we had this resistance, and let's get the big white one instead of just the medium. So this is the first rejection, second rejection, and fourth rejection right there. And then we were squeezing with this support zone, and we squeeze, push to the downside, retested the previous support as a new level of resistance, pushed the downside, a bullish little rally there, a continuation move, and then we got another sell-off, taking us to the lower low that we currently see hold right now. And then we got the low, and then we got a resistance right here, and then we got a lower low, lower low, lower low, and then this support zone that we held right here is going to be the new level of resistance. So we're just right now in a tight consolidation, in my personal opinion, where the momentum is really to the downside, but we got a support and resistance here, and we're just going to be looking to see which way this consolidation goes, except my personal bias, just looking at the price action and what recently happened from here, once it broke this support zone and this zone of confluence right here, my bias was a risk off sentiment. Global investors were looking to have a lower risk tolerance, and we're getting out of things like equities. And then we did see a sell-off soon hereafter, which was favorable for sure, and now we're at a point where we're going to get our next battle zone, our point of intersection between buyers and sellers, where they're going to have to battle it out. Either we're going to go to the upside or downside, obviously, but the momentum and the overall sentiment, in my personal view, is going to be to the downside. We do see COVID cases increase, not just in America, but around the world, which is obviously a bearish sentiment. But markets haven't really been worried too much about it, to be completely honest. We don't want to be extremely bearish just yet. The markets have proved themselves to be extremely resilient in times of uncertainty, well, especially the United States market. So we want to be careful before we go Hail Mary and say this is an absolute short. We should just hold until it goes down and breaks the low of March. We shouldn't be in that mode until we break, in my opinion, the 29.75 zone. That's the point where we really have to be looking at exponential moves to the downside, in my personal belief. So that's the S&P. We're going to look at some other indexes to get a better gauge of the overall market. I think the Russell 2000 is a really well-respected chart as well. We were holding these nice higher lows, very well respected right here. So we do not want to, in my opinion, really look for any opportunities until we get confirmation that we're not only breaking this ascending zone of support, but also the horizontal zone. So then we would have to have a shift in the structure on a large time frame. Now, what you can also see within this is a head and shoulders. If we break the around 1365 zone, that would be the completion of the head and shoulders pattern. We can see that this is the left shoulder and the right shoulder was able to hold. We can see wicks that were trying to push the price above a certain zone, but the sellers, the bears, were able to gain confidence, conviction, and keep that price closed at the high of the left shoulder. So that, in my opinion, is the completion of a pattern once it breaks the zone of confluence, where you have not only the ascending zone create a trend line holding the price, making higher lows, but also the previous level of resistance within this consolidation zone right around here. Right, you see a consolidation. You could argue that this is a squeeze occurring like that, but you see this major structural resistance, even if you pull that back right here, which is now acting as the breakout point for our head and shoulders. So if that breaks, I think there's going to be quite a bit of a loss in confidence in the buyers of the small cap market, which is the Russell 2000. It's a representation or an index of the small caps. Now we're going to look at the NASDAQ really quickly. We did get an all-time high to hit. The candle that actually created the all-time high closed extremely weak. We got a shooting star there where you get the buyers to initially push it up very aggressive, but the sellers in the same day, in that same time frame, pushed it right back down very close to the open of the initial candle, of the initial day. Not great to see. And then you got that next candle, which is closed, which is definitely pretty bearish compared to the previous day. It is holding our nice little level of support, which is around 99.70. Previous level of resistance was this candle closure right here. And then you see that it was a candle wick touched right there. So that's going to be our initial indication. You see that the candle open and close at that zone, and then you see it hold the 99.63 zone since really June, and even if you really count early June. But overall, it does look like if it falls below that 99.70, 99.65 zone, I'm definitely going to be assuming that there's going to be some risk taken off the market, meaning that there's going to be a continuation to the downside. And then the next area of support that I will be looking at is a little bit bigger, previous all-time high here. And then you see that the buyers were able to hold the previous resistance. You can see that pretty well right here. Resistance turned into support. You could potentially just split that off into two, like so, and then you have that resistance zone right over here if you were looking at smaller time frames, but I kind of view that as a pretty large demand zone. And then if we go beyond that, we're definitely going to be a ways until we're getting to our next major zone. We can see that right here. So as of right now, we don't want to be calling it too early. Looks like it took a little bit of a tumble, but as of right now, the NASDAQ still looks like it is holding our new level of support. And the VIX popped up a little bit today. Not a whole lot actually happened in terms of how aggressive the VIX could be acting in sell-offs. So looks like that next pop could be starting. What usually, obviously, the VIX does is just see low consolidation, and then you get these massive spikes, and it does look like that next possible spike could be emerging, but definitely really early to tell as of just yet. We do see if it breaks above this potential zone, that could be an indication, because we see it reject 1, 2, 3, 4, 5 days in a row, and this candle is also a rejection off that area. So if we start seeing the momentum move to the upside, definitely considering it a risk-off environment. But if we get a continuation to the downside where we're just getting, let's get our bars pattern. If we just get like a continuation kind of like that, that's definitely a risk on sentiment because decreasing volatility is usually shown on the S&P by slow crawling upwards momentum, which is usually how the S&P climbs in normal markets, I guess you could say. Not in these massive bull rallies that turn out to be bullish parabolic moves, basically. All right, now we're going to go into some other markets here. This is going to be looking at some oil, bonds, as well as the US dollar index. So let's first look at some oil. Oil actually took quite a bit of a spill here where it broke out and failed to make a double top. We do see that the candle closed above that zone on the 4-hour, 6-hour. Even on the daily, we did see a higher zone, and the candle closed actually higher than the wick. So that to me is a failure of a double top on the daily. But we are seeing quite a bit of sell pressure coming into the market. I think that major zone that we have been talking about at the completion for a possible double top would be around the $34 zone. We can see that was a key level of support and previous level of resistance. And if we even take it back to March of this year, it was a key level of resistance before we got another sell-off and then a continuation and the momentum to the downside. So that's going to be the major level of support that we currently see. And right now I still view the market like a consolidation like so. It is slightly making a marginally higher high, which isn't fantastic. The fact that we couldn't aggressively push to the upside, we made a marginally higher high and then got slammed down, definitely for me indicates that definitely some sellers in the market that was able to push the price back down. And the worry of COVID, if lockdown starts again, there's going to be less transportation happening, there's going to be less production, and overall that is pretty bearish for oil. So kind of makes sense that we're going to take a bit of a dive here. Could draw in a nice little ascending zone that did break right there, and then you could even create a nice little wedge formation if you do. If you did see that. I did not trade this. Normally do not trade oil, but that could be the second failure of that high, and then we're getting a nice little sell-off here. We do have some mid-range zones, like right around here, that we're currently testing as support zones, but I think that next zone, if it breaks $34, is going to be a major point for oil if it does fall below that zone. But if it holds that, if it consolidates, we could just see a consolidation, like we've seen consolidations here. That was quite a consolidation, and you can say that was another ascending zone that failed right here, and then it held the previous low like we're seeing right here, and then it continued upwards. So I don't want to say that just because we're making lower lows and lower highs within this structure that we're extremely bearish just yet. We're still continuing the sideways consolidation, failing to make a significant higher high. I'd still classify this as a sideways move, and then we're just now probably going to be testing that low, which makes sense because I am a little bit more bearish on the overall stock market, it looks like, and oil and markets are, or stock markets are both a risk on sentiment driven market. So that's currently what I view on oil. We'll take a quick look at the US dollar index, which is This is mainly just an inverted chart of euro dollar or euro USD, because this is mainly comprised of euro, 60%, and then you get some GBP, some krona, some other currencies, but it's mainly or JPY as well, and then GBP, and then you also get some other smaller currencies, but mainly it's euro. We can see after this large squeeze that I'm sure everyone knows, if you do follow DXY, you get a nice ascending wedge that broke to the downside. So then if you're just looking at possible TP levels just in terms of geometry, you're looking at a potential double bottom there. And then if that is the case, you'd be then viewing this structure as a consolidation sideways until you get some formation that is going to indicate a break of this $95 range. If we do look back at the daily, and actually if we go to the weekly chart, it really shows it a lot better. How is a previous resistance, and resistance right here, turning into strong level of support multiple times, with the weekly closing right at that 96-ish dollar range. And we can see that there's been wicks hitting that zone, getting picked right back up each time. So in terms of key levels of supports, that 95 range right there is a major level for DXY. If it fails and goes below that zone and holds, we see that it failed there, but it picked right back up, held that previous resistance as a new level of support, and then once it broke that previous high, definitely you see lots of bullish activity with wicks coming down, picked right back up. You see lots of activity where buyers are entering the market at this zone. That is probably going to be a wick. Obviously, you don't know beforehand, but if you see the price hold, consolidate, slowly grind, making slow higher highs and higher lows, forming some level of an ascending wedge, it's probably going to stick around there, and that is what you're looking for if you want continuation to the downside for the US dollar index. And if you're looking for dollar weakness, most likely you want crypto to be long, you want gold longs, you want silver, SPX usually, because obviously everything is a pair in the stock market. You're comparing everything to the US dollar. If one thing is absolutely stable and then the US dollar is dropping, that thing that is stable, that asset, is going to look like it's appreciating in value, but it's really not. So that's the illusion of a devaluing dollar. If you look at the stock market in Venezuela during the hyperinflation, the stock market looks like it is in a parabolic bull run that is better to be in than Bitcoin in 2017, mid to later 2017. But the value, the actual value and the production of the businesses were decreasing. So got to look at a paired system, not just one asset. So that's going to be the DXY. We're going to quickly look at bonds. Not a lot has happened. We're looking at the 10-year yield and the 5-year yield. We're really just basing at this point with the 5-year really not moving much. But if we do get a plummet, obviously people are driving capital into bonds, which is a risk-off sentiment indicator for me at least. If people are wanting to invest and put money into bonds at a yield of 0.327 for 5 years, that to me is pretty bearish. I don't know about you, but I don't think I would want to be doing that. And the fact that people are, for me, gives an indication that people are worried, and you can do a lot. You can do a lot with that information. So that's the overall structure for bonds, oil, and the US dollar. All right, so now we're going to go into gold and silver ratio really quickly, and then we'll go into the questions. I'm not really going to go into the larger time frames for gold because we've already talked about it. And we're just going to discuss what we currently see within the structure on a smaller time frame, 2 hour, 1 hour. We already know that this is a major zone that broke. We had a nice ascending triangle right here with a series of low, higher, low, higher, low. So then you connect the higher lows, forming an ascending triangle pattern, broke to the upside. You're looking for that nice, significant higher high to hold, which is right here, higher than the previous high around, let's say, 1765, and then significant higher high, which is great to see. And then you're looking for that nice retest, that validation of a previous resistance turning into a new level of support, which is occurring right now. So that's on the larger 4-hour, 2-hour time frames, and when we actually zoom into a smaller time frame, we get a nice type A candle closure where especially this big hammer wick right here, to me, indicates that there is a lot of buy pressure. Let's get our brush. This wick right here, to me, indicates that there is a lot of buy pressure pushing the price back up, forming this new solid level of support from this previous resistance zone. So in my personal belief, it does look pretty solid in terms of risk rewards and the potential for it to hit the next target, which is around 1800. And you've got a zone of confluence here that you can depend on, in my opinion, for an area of demand, because we see not just this zone, but we see a wick coming down to the downside here as well as here. So you do see wicks to the downside. Right now, it's not looking, to be honest, absolutely great because we see lots of wicks. When we see that right here, not great because you see sellers pushing it back down when buyers are trying to pick back up the price and move it upwards. So you're not seeing a series, you're not really seeing any higher highs, you're seeing lower highs. But if you get one bullish candle to break it with a bullish engulfing candle, that would completely change the story in terms of an entry. But on a large, if you're just zooming out, it looks super bullish. This is the demand zone, and the potential for a solid risk reward trade is pretty high, and it's a dependable situation in my personal belief. We will also go over the correlations that gold has with traditional markets. So we can see this is gold, GC right here. So this is gold on the CMX, and we'll go like here. This is a correlation chart. This is the previous 30 trading days. And what you're looking for is either negative or positive correlation. Let's say you want a situation where you're long gold. What needs to happen in order for that to actually occur? Well, let's look at correlations. Well, ideally, you would want things like the Dow Jones, the S&P 500, the NASDAQ, and the Russell 2000, and the Japanese stock market to all go down because they are around negative 0.37-ish% correlated. It's out of 1 to negative 1 in zero correlation. So if you're looking at it from 1 to negative 1, it's somewhat negative correlated. So that means if the Dow Jones goes down, gold, theoretically, if you're looking at just in terms of correlations, should be somewhat in a bullish trend or getting some level of bullish activity because it's been negatively correlated in the past. And if you're looking at things like Eurodollar or the 10-year T-notes or Treasury notes or the 30-year Treasury bonds, those are risk-off assets. Those are assets and instruments that people go to if they're worried, if they're uncertain, if they think that the market overall is going to go down. So you are looking for a risk-off environment if you're long gold. And then if you're looking into silver, okay, well, let's look at silver. Silver is right here. You have a 0.22 positive correlation with gold in the past 30 days. So if you're looking to long silver, okay, well, gold ideally would be going up as well. And then the stocks should theoretically going down a little bit. So then you get a good understanding of not just one asset, but the entire market as an interconnected single mechanism for basically gauging the risk tolerance of global investors or global capital, you could say, which is really, really interesting. So that's kind of the overall structure that we're looking for in order to potentially long gold if you are looking to long gold. And then also we do talk about silver, and we did talk about silver, and something to note before we talk about silver is the gold and silver ratio is going up on a pretty important level of support. We see around 95 is the previous ascending wedge resistance, which is now going to be a support. Also, we can see was a previous resistance, which was held right here, new level of support, around maybe the 96 to 95 ratio zone, meaning you can get 96 ounces of silver for 1 ounce of gold, and it's this is the highest peak it's ever been, 128, and we can see that it's slowly climbing back up. It doesn't mean that silver is extremely bearish, but you'd be looking to enter in gold instead of silver when this chart is going up. And when you see these huge spills to the downside, you're looking to be in silver more than gold. So in terms of structure, it doesn't look extremely bearish. It looks like it's just in a consolidation. We might just form a nice little support right here, or resistance right here. We see it was initial resistance, and then it blew through it, and we see that was a huge wick that got rejected by the sellers and got pushed right back down. We see a wick that touched that around 100 zone, which is a pretty psychological level, and then we're holding there right now. So if it starts to move back down, it means silver is appreciating at a faster rate compared to gold. Doesn't mean that gold won't be bullish, it just means silver will be more bullish. And usually this turns pretty aggressively when you have metal bull runs. So that's going to be something to look out for. But in terms of silver, I don't love it right now. We are still forming lower highs, and I'm going to be looking at this trend line to see if that's going to break. So until that breaks, I don't really want to be entering anything within this range. You could be looking at this zone as a potential ascending zone if you really want to, like that. I'm viewing it more as just a horizontal zone of support somewhere around here, and a descending zone of resistance. And we might form a series of higher lows that is able to hold, which will create a symmetrical triangle. But as of right now, the way I'm viewing the silver market is just a nice horizontal zone of support at around the $17 range, maybe a little bit higher. And then a descending level of resistance that is connecting the lower highs, and it's slowly squeezing the price. I don't have any real desire to jump into silver just yet. It doesn't seem like it's ready. Gold seems like it is looking a lot more favorable for a long right now. Things could change where silver makes a strong push to the upside. You could form a potential symmetrical triangle if you get a squeeze within the descending zone, kind of like here. So then what you'd be looking for, if you get something like this, is that to hold, and then you get a symmetrical triangle, which was initially a descending triangle, and then you're looking for that pop. Oops, that is not what I'm looking for. You're looking for that nice pop. That previous resistance is probably going to be acting as your new level of support, and then you're looking for that nice solid entry if you can find it. But as of right now, it's definitely not looking ready for an entry, so I'm just going to leave it at that. All right, so now we're going to look into some of the questions here on TikTok. We're going to leave the S&P 500 here just for us to look at while we go over the questions, and then we'll dive into the questions, and then we will go over some crypto after we've completed that. So I'm just looking at YouTube to see if I have any questions. I don't have any questions on YouTube. So I'm going to get a little bit of coffee, and then we'll jump right into the TikTok questions. All right, so Super Dunk said the whole problem with a capitalist system is that inevitably it will collapse. I personally don't agree with capitalism being the issue. I think capitalism and free markets will create a prosperous environment in an economy for businesses to grow, thrive, and innovate. I believe capitalism and free markets work. I think central banks is what cause issues and will create the inevitable collapse. Printing money out of thin air is the problem that we're dealing with in terms of the inflation of the topic at hand with this video, in my personal belief. So I kind of disagree with you on that one, but I wonder if we are heading that way. Yeah, maybe. But I personally think that capitalism works. I think free markets work. I think not having a central government that controls everything works. I think actually having a government that controls a lot of what society has does not work. We already know that basically having structured costs do not work. You can't, say an apple costs this much and it's a fixed rate and a central entity controls the cost of everything. That does not work. That will never work in a society. You need free markets. in my personal belief. And that will create the most sustainable economy and the most prosperous economy, where good ideas, innovative ideas will grow because capital will flow into them. Because obviously, if you're making good investments, usually they appreciate in price. And that is the proper way to run a free market, is don't bail out companies because they were improperly run for a decade and bought back shares instead of reinvesting and trying to create a more efficient business. You don't get any of that in a free market. And we're currently not living in a free market, in my opinion, where it's not capitalism. Some corporations are just able to get bailed out because they're, quote, too big to fail, which is not a free market. You'll notice that typically on the fourth touch of the support or resistance will indicate a bigger breakout or decline. Yeah, if that is what your back testing suggests, then that is awesome that you are able to create a system in which you have and found edge for you. FX trader, what do you think? I'm not sure about what do I think about. I'm trying to look for. I do not see any questions before that. So FX trader, if you would like to ask a question, definitely feel free. But I do not currently know what the question you're asking. DSE, hello again. Dan Pena said he knows personally Satoshi, and when his face will become public, BTC will be zero. I don't know about that. He did say that Vladimir Putin is the creator of BTC. I don't think so. Obviously, I don't know who the creator of BTC. It could be a team of people. It could be a woman. It could be a man. It could be anyone, right? So I don't really know what to think about Dan Pena. I know the guy. Older dude. Yep, loves to yell and swear. Kind of a motivational speaker or whatever. Yeah, we will see. All right, DSE, what is your job / occupation? I trade. This is my job. I also run a couple other businesses, one of which is an educational business for cryptocurrency education, trading, TA, and I also trade, part of just retail, but then also I am a part of a prop firm, so a proprietary trading firm, and I have a couple other stuff on the side as well. But yeah, entrepreneur, I would say, would be the best way to describe myself. You should try to be the best. You should try to be more interactive with the chart during the live presentation. Yeah, so we are trying to get through quite a bit of information, so we do pause, like we can see right now, where I will interact with people midway through, because going through an hour without any sort of interaction from the person providing the analysis obviously is not great when you are providing a live service. So we do break it down. We started at around 40 minutes, so I am going through all the Q&A now, and then we'll go over crypto, and then we'll finish it off going back and finishing up the Q&A for any questions that were posted in between the midway point and the final point. I'd rather he focus on breaking down the charts than interact with us. That's far more important. So, Super Dunk, thank you very much. I kind of agree with you on that one, but I see both sides for sure. Between topics, you could try to answer questions related to that chart or graph is just a suggestion. Yeah, so I try to, like, the first half was the global macro update, where we're looking at assets across the board, more traditional assets, looking at global indexes, mainly US indexes, looking at volatility, looking at commodities, looking at bonds, getting a good understanding of the risk tolerance of global investors. That is the goal of our global macro update, because then it gives us a good understanding of overall sentiment, and that can play a role in how we identify our edge, which is first getting an understanding using multi-asset analysis to get a firm grasp of what we think is happening in the markets. Obviously, no one truly knows 100%. There's algo computers that can collect a million times more data than my brain can. But in terms of just being a discretionary trader, these are the tools that I use to just try to get a pulse on the overall market. Do you think that the altcoin rally is coming soon? All right, so this is, I think, the point where we're now going to switch into the crypto realm. We talked about a bunch of stuff in terms of global macro, and now we're going to get into crypto. So I think a great chart to understand your answer is going to be what's called the total 2, and this chart represents the total cryptocurrency market cap excluding Bitcoin. So we know that Bitcoin, we can see on this chart, is currently around 65% of the total market cap. That's a significant portion of the overall cryptocurrency market. I'm sure you are well aware of that. So two things that I personally use in order to gauge whether we should be heavy alts or we should be more, risk adverse and look into just storing more capital in BTC, because when we do have bear markets, BTC holds its value better than any other alt. Mostly. Some like Link have done better, BNB has done better, some have done better, but overall, if you're looking at the entire altcoin market, BTC generally does better in bear markets. An altcoin rally 2017 explosions where you get massive parabolic moves, different story. So this is the first chart we're looking at. The ticker is total 2, and like I said, it represents the crypto market excluding BTC. And what I currently see is just a sideways consolidation, right? This is the log chart. So we're range bound around 116 billion as a resistance and around 40 billion as a support. And we can draw in a descending trend line connecting the lower highs because we are getting lower highs. And now, in my opinion, we are able to form a nice descending triangle formation. Obviously, you're not going to trade this, but it gives a good, in my opinion, understanding of how the overall altcoin market is compared to BTC. Because right now, BTC is, let's see, at 93.20. This isn't even close to where BTC is in relative to the high in terms of how far it's actually been able to rally. It looks very similar to Ethereum, which is a large portion of this chart. So that's number one. I don't see it break yet, so it's not a time for me to go alt heavy yet. It could be later on, but right now I don't see that situation happening just yet. And if we zoom into a smaller time frame like the 6 hour, we can just quickly identify key level of resistance. You could form a series of lower highs, which I think I will do instead of a horizontal zone. So you see a series of lower highs, and then you can just draw in a nice previous resistance turning into support. And if it breaks below the 85 billion mark, obviously that's going to be a shift in market structure, which could indicate further momentum to continue the downward move. It's not a guarantee, but at this point in time, if you are looking for alts, you might be looking to really start entering at the break of this zone, kind of over the 95 billion mark. So that's going to be the first indicator that I personally use if I should be kind of going into alts or not in terms of investments. The second thing is going to be looking at the BTC Dominance, which we've already touched on a little bit. But if we go to the weekly chart, we can see back in 2017, we had a massive decrease in BTC Dominance. No questions yet. So we had a massive decrease in BTC Dominance. I'm just making sure the questions aren't coming in. And that was when we should be in alts. When you had BTC get basically a lot of its market share taken away by a lot of different alts. And we can see this huge amount of sell pressure here. So then if we go like so, we can see there is a series of higher lows. And if that breaks to the downside, I think we're going to get something like this, where you get a break in support, and then you get a massive, what you would call a sell-off normally, but it just basically means that alts are taking more of the overall market share of the cryptocurrency market. So if this does fail, because we're currently forming a squeeze where you get a series of lower highs and higher lows squeezing the price into the apex of the symmetrical triangle, if it breaks to the downside, creating a lower high or lower low, in this zone, that is going to be the point in which we do have to potentially consider an altcoin market rally. And until then, I cannot say that we should really be in alts. I think BTC is a better play until this does break down or below 63%. BTC has market cap of the total cryptocurrency market. So hopefully that gives you an understanding of what I currently look at in order to assess the level of capital I put into alts versus BTC. And that was a good way to kind of start the overall BTC market, crypto market update basically. And let's go to the daily. And let's actually zoom out, because we can see we're really topping here, meaning that we're starting to make lower highs and higher lows. We're squeezing, and we're going to break at some point soon. We're really contracting in overall relative volume and price movement. So we do see a series of lower highs right here and higher lows right here. So we're squeezing. I think there's a higher probability of potentially moving to the downside than upside a little bit more, but we will see. We'll always let the price action speak for itself. But we do have to understand that there's some major resistance if we are looking for any longs. I'm currently not, because I do not think that we will break these zones. But around the 10.4 and around 10K zone is going to be some major resistance we do have to take into consideration if we are looking to, or if you are looking to long at the break of this descending zone. And we have a minor level of support right over here. Let's just get that zone, which is kind of the midpoint of this triangle anyways, which is a pretty important zone. So that's what I currently see in the market on the daily time frame, is a squeeze basing, and I think we are inevitably coming to the end of the base, it looks like, or coming close to it, where, let's just change the color there, where the apex is on mid to early July. I don't think we're going to get there, but I think it'll break beforehand. If we get there, obviously the market will have to make a decision at some point later time. So then we'll be reactionary and wait until that event does come into fruition. So that's currently the daily. I think it's a pretty well respected pattern overall. And like I said before, the $8,500 zone is the main zone of support that I see before we start to look for major continuation patterns to the downside, similar to what we got within this ascending wedge right here. You're looking for some sort of structure that allows you to have an edge trading momentum, carrying the momentum to the downside. That's going to be basically the overall setup that I currently see for BTC on a larger time frame, at least. All right, so unfortunately, on a smaller time frame, we did fail. We did have this zone right here break, which was that break right there. So once it broke that zone of confluence where you get the previous resistance right here to act as a new support, that was a really good push to the upside. And then we held this zone right here. Let's get our snip. So we were holding this descending wedge really well, and then we were able to form something like that. Did break to the upside, which was really good to see, and then we were holding above this previous resistance, which is also a nice level of support shown right here. So it did look like it was looking favorable for the buyers, and then if you were long, I think that stable support would have been a good time, which is what I did, which looked pretty good. But at that point, once it cracked here and held, that would be a oh shit for the bulls, in my opinion, and then you should be looking to consider potentially taking some off, because if you are looking to use this as a potential breakout period, you must have known that there's going to be lots of sell pressure. So you've got to be quick to be flexible, especially if you're a retail trader and you have the ability to be flexible and nimble. Got to be able to try to move that stop loss up and reduce the risk if you can, especially when you're longing into so much resistance, so much supply into the market. So as of right now, we are now closing this descending wedge, which failed. It failed to hit target. So now we're just now in this squeeze right here. It looked good. It failed. Patterns fail all the time. That's just how the market works, basically. Is sometimes they fail, sometimes they work. It's a probabilistic situation. You do not have control over the outcome. You only have control over what you enter, your risk management, your position sizing, and your ability to control your psychology, which is inherently an edge as well. So
In terms of the larger time frames, not much different from the daily. We're squeezing between a series of lower highs and higher lows. We failed to break hitting target of the descending wedge, which is an indication to me that buyers are just not as strong and not as confident and don't have much conviction as the sellers in this current market condition. So I'm basically gonna wait until I see a break in the resistance. I'll still be very hesitant, but not ideal, but the place I'm going to be looking for a higher probable situation where I'm going to be more favorable to enter would be a short, especially breaking 85. If it breaks 9K, that's going to be the first indication, like, okay, we could be going further down. And then once it breaks 85, that's going to be, okay, we are now officially looking for short opportunities to short Bitcoin. And basically every single alt added with that, because if BTC falls, alts will fall harder more often than not. All right, so got a little bit of coffee there. So I don't really see any more questions coming in. So that is going to be the completion of the global macro update as well as the crypto market update. We've been kind of combining them. Instead of doing two videos, we just do one a little bit longer one, and then we'll provide timestamps so people can go into whatever subject that they're looking to get out of the video. So I'll leave maybe one more minute just on TikTok, so if anyone has questions, they can post them up right now, but I will complete the recording right now. So thank you very much for watching. I really appreciate it. If you found this video useful, informational, educational, entertaining, it would be great if you would subscribe to our channel and like the videos so we know that we should keep on doing videos like these. For the people who have been commenting, we really appreciate the continued support and the engagement, and obviously the comments. We really appreciate it, and that's kind of why we do it. We try to provide some good analysis for people to get an overall pulse of what's happening in the market, not just a single ticker, but looking at multiple assets, multiple tradable situations where it's not just, what is gold doing, but what does the overall market sentiment look like, which is pretty important. You're not going to get everything. You're not going to get all the data. Obviously, there's a lot of variables that play into each of the assets that we look at, but that's our goal within this YouTube video and this series. So thank you very much for watching, and until next time, have a good one.